Here's a number that should stop you mid-swipe. The average credit card charges somewhere around 20% interest, not 20% a year on some risky investment. 20% on money you already agreed to pay back, sitting in your wallet right now, backed by nothing but a signature and a promise. Everyone uses credit cards. Almost nobody stops to ask why banks are so desperate to hand them out, mailing offers to people who never even applied, practically begging college students to sign up for their very first card. That eagerness isn't generosity. It's one of the most profitable products in the entire banking industry, and the profit doesn't come from the way most people assume, but that's only part of the story. Because to understand why credit cards generate billions of dollars a year for banks, we first need to understand something almost nobody reads before they sign up. The actual math behind that little piece of plastic was never designed to be understood at a glance, and that's not an accident either. Let's start with the number everyone already knows a little about: interest. When you carry a balance instead of paying it off in full, the bank charges you interest on whatever you owe, and it compounds, meaning you can end up paying interest on interest you already owed from a previous month. A card charging 22% annually might not sound catastrophic at first glance, but spread across millions of cardholders carrying balances month after month, that rate turns into one of the largest, most reliable revenue streams in the entire banking industry. Here's the part that should genuinely surprise you. Credit card interest income for the banking industry runs into the tens of billions of dollars every single year, and it comes almost entirely from a specific group of customers the industry has a name for. They're called revolvers, people who don't pay their balance off in full each month, and they make up a significant share of all cardholders. Meanwhile, people who pay their balance off every single cycle are called transactors, and from a pure interest standpoint, they are almost worthless to the bank. Wait, if paying your balance off in full every month makes you nearly worthless to the bank's interest income, why do banks still want transactors as customers at all? Nobody expected this next part because the answer reveals an entirely separate business, hiding behind the one everyone already knows about. This is also why banks are so aggressive about signing up young, first-time cardholders mailing pre-approved offers to college students who have never built a credit history at all. A new cardholder with a small credit limit and little financial experience is statistically more likely to carry a balance in the early years of card ownership than someone who has been managing credit for decades, which makes that first card, seemingly small and low limit, one of the most valuable long-term customer acquisitions a bank can make. The relationship formed with that very first card often determines which bank handles that person's mortgage, auto loan, and savings account decades later, which means the modest interest and fees collected in the early years are, in a sense, just the opening move in a much larger financial relationship the bank is quietly hoping to build. Let's walk through what this actually looks like with real numbers, because the abstract version of this story is easy to nod along to, but the specific version is where it really clicks. Imagine a bank issues 1 million credit cards, each with an average balance of $3,000 carried month to month, at an average interest rate of 22%. That alone generates roughly $660 million a year in interest income from that single card portfolio. Now layer in interchange. If those same million cardholders spend an average of $15,000 a year combined on purchases, and the bank collects an average interchange fee of 2% on that spending, that adds another $300 million a year, arriving regardless of who carries a balance and who doesn't. At even a modest assumption that 10% of cardholders trigger one late fee a year at $35 each, and that's another $3.5 million, almost pure profit, layered on top of everything else. 3 completely different revenue streams, running off the exact same customer base, often off the exact same individual card, adding up to a business that can be enormously profitable even in years where the broader economy is struggling. Because people don't stop using credit cards during a downturn. If anything, more people start relying on them exactly when money gets tight, which is precisely when interest and fee revenue tends to climb the fastest. This is where things went wrong for a lot of cardholders who assumed a credit card was simply a convenient way to pay for things. It was designed to feel that way, deliberately, because friction and confusion are part of what makes the entire system so profitable. A card with a clear, simple fee structure that never surprised anyone would generate far less revenue than one where a missed due date, a slightly late payment, or an accidental overseas purchase quietly triggers an extra charge nobody budgeted for. Everything changed once you understand that a credit card isn't really one product. It's 3 separate revenue engines running simultaneously: interest from people who carry balances, interchange fees from every transaction regardless of balance, and penalty fees from the moments people slip up, all stacked on top of each other, all running at the same time, on the exact same piece of plastic sitting in your wallet. There's a fourth layer to this that rarely gets discussed openly, and it has nothing to do with fees at all. It's psychology. Multiple studies on spending behavior have found that people tend to spend meaningfully more when paying with a credit card compared to cash for the exact same purchase. The pain of parting with physical money creates a small, automatic hesitation that a card simply doesn't trigger because swiping feels abstract, disconnected from the actual dollar amount leaving your account. Banks and merchants both benefit from this effect. Merchants sell more per transaction. Banks collect a larger interchange fee on that larger transaction, and if the customer ends up carrying part of that spending forward as a balance, the interest engine gets a bit more fuel too. Nobody needs to trick you into overspending. The format of the card does a meaningful amount of that work on its own. This is also where rewards programs come into play, and they're often misunderstood as a pure gift from the bank. In reality, the cashback or points you earn on a rewards card are largely funded by the very same interchange fees merchants are already paying on every purchase. The bank takes a cut of that fee, shares a portion back with you as a reward, and keeps the rest. It works out well for disciplined transactors who pay their balance in full, effectively getting a small rebate on spending they were already going to do. But the same reward structure often comes attached to a higher interest rate than a basic no-frills card, which means the moment a rewards card holder starts carrying a balance, any rewards earned can be wiped out many times over by the interest charges accumulating in the background. There's one more mechanism worth understanding, and it might be the quietest, most effective piece of the entire system: the minimum payment. Every statement lists a minimum amount due, often a small fraction of the total balance, specifically low enough that it feels manageable, no matter how large the underlying debt has grown. Paying only that minimum feels responsible in the moment. It technically avoids a late fee and technically keeps the account in good standing. But because interest keeps compounding on whatever balance remains, paying only the minimum on a large balance can stretch repayment out for years, sometimes decades, and the total interest paid over that time can end up costing far more than the original purchase ever did. The minimum payment isn't designed to help you pay off debt efficiently. It's designed to keep the account open and generating interest for as long as legally possible, while still feeling like progress is being made every single month. So here is the reveal that ties every piece of this story together. Credit cards were never really designed to be a simple payment tool. They're a finely tuned system built to extract value from three completely different types of behavior at once: spending, carrying debt, and making small mistakes. And the genius of the design is that almost every cardholder falls into at least one of those categories eventually, often without realizing which one they've become. Knowing how this system works reveals a handful of mistakes that quietly cost cardholders the most money over time. The first is treating the credit limit as a spending target rather than a safety buffer, since the bank sets that number specifically high enough to tempt spending beyond what a comfortable monthly payoff would require. The second is applying for a rewards card based purely on the point multiplier without checking the interest rate attached to it, which matters enormously the moment a balance carries over even once. The third is paying only the minimum without realizing how much of that payment is going toward interest, other than the actual balance, a split that's usually printed clearly on the statement but rarely actually read. And the fourth is assuming a missed due date is a minor inconvenience, when in many cases a single late payment can trigger a much higher penalty interest rate that applies going forward, sometimes permanently, on that account. People who use credit cards most effectively tend to do the opposite of all four. They treat the credit limit as a number to stay well under, not a target to reach. They compare interest rates before reward structures, since the rate only matters if a balance carries, but it matters enormously when it does. They pay more than the minimum whenever possible, specifically to attack the principal balance rather than just covering that month's interest. And they treat the due date as non-negotiable, often automating at least the minimum payment so a single forgotten bill never quietly reshapes the terms of the entire account. None of this makes credit cards inherently a trap for every single person who uses one. Plenty of cardholders pay their balance in full every month, earn rewards points or cashback funded, largely by the interchange fees merchants are already paying, and genuinely come out ahead using the system exactly as the transactor category intends. But there is an enormous difference between using a system that was built with careful, deliberate incentives and assuming that system was built primarily with your convenience in mind. It wasn't. It was built to be profitable across every type of customer who might ever hold that card, and the fact that it can also be genuinely useful for disciplined spenders is closer to a happy coincidence than the actual design goal. So the next time that little piece of plastic comes out at checkout, You'll understand what's actually happening in that split second the transaction clears. The merchant just paid a fee neither of you saw. The bank just collected a sliver of revenue that cost them almost nothing to generate. And somewhere in a spreadsheet you'll never see, you've already been sorted into a category, revolver or transactor, that determines exactly how profitable you are to the company that mailed you that card in the first place. If this changed how you think about your own wallet, subscribe. New videos breaking down the hidden economics behind the businesses and industries you interact with every single week. People who use credit cards most effectively tend to do the opposite of all four. They treat the credit limit as a number to stay well under, not a target to reach. They compare interest rates before reward structures, since the rate only matters if a balance carries, but it matters enormously when it does. They pay more than the minimum whenever possible, specifically to attack the principal balance rather than just covering that month's interest. And they treat the due date as non-negotiable, often automating at least the minimum payment so a single forgotten bill never quietly reshapes the terms of the entire account. None of this makes credit cards inherently a trap for every single person who uses one. Plenty of cardholders pay their balance in full every month, earn rewards points or cashback funded, largely by the interchange fees merchants are already paying, and genuinely come out ahead using the system exactly as the transactor category intends. But there is an enormous difference between using a system that was built with careful, deliberate incentives and assuming that system was built primarily with your convenience in mind. It wasn't. It was built to be profitable across every type of customer who might ever hold that card, and the fact that it can also be genuinely useful for disciplined spenders is closer to a happy coincidence than the actual design goal. So the next time that little piece of plastic comes out at checkout, you'll understand what's actually happening in that split second the transaction clears. The merchant just paid a fee neither of you saw. The bank just collected a sliver of revenue that cost them almost nothing to generate. And somewhere in a spreadsheet you'll never see, you've already been sorted into a category, revolver or transactor, that determines exactly how profitable you are to the company that mailed you that card in the first place. If this changed how you think about your own wallet, subscribe. New videos breaking down the hidden economics behind the businesses and industries you interact with every single week.